Bank failure will destroy the housing market. If you're new to the channel, welcome aboard. If you're a returning viewer, I appreciate your participation in our journey. I would be completely irresponsible in my duty to share with you the best information so that you can make the best decisions for yourself, for your family, and for your financial bottom line if I did not cover what's happening right now and the systemic risk that exists right now in our markets, in our economy, which will destroy the housing market and many other markets too, because we're seeing banks fail right now in real time today. And I remember very clearly exactly what it was like when I was a stockbroker and systemic risk was real, when there was blood in the streets, when the financial sector was getting absolutely decimated and we were watching the stock market tumble. We had panic, we had fear, and the government and the treasury took unusual measures too big to fail to save the system. And many folks will argue that they did. And others will say that they really just kicked the can down the road a bit. And we're going into a cycle of having to face the economic reality of what that decision was way back when. And as of today, none of that has really impacted the Florida housing market. Now, it's factually true that the US housing market has taken it on the chin. We've lost $2.4 trillion in homeowner equity in the near term. And there are lots of folks out there that believe that the housing market bottom is in. I'm just not one of them. Now, as of the making of this video, it's Friday afternoon, and great news! The inflation numbers, or excuse me, not the inflation, the unemployment numbers came out, and they were better than anticipated. And so, what did we see? Well, we saw mortgage interest rates drop a little bit, and we saw the stock market start to rally a little bit, up until we saw a major failure in the banking sector. And that's what we're going to talk about today. And headline news is that Silicon Valley Bank is shut down by regulators in the biggest bank failure since the global financial crisis. And the stock market, which prices in change instantaneously, sold off to the tune of about 300 points. Wall Street no likey, and neither do I, because I remember what it was like during the last financial crisis. I remember having to advise clients that they should not be over the FDIC insurance in any of their bank accounts because anything over that amount is not insured and could be at risk. And when the general population, Gen Pop, thinks that banks are at risk of failure, they pull their money. There's a run on banks. There is systemic failure. And I can assure you that if that happens, the housing market and every other market that trades will be destroyed. Period. End of story. Because a run on banks and systemic failure is no bueno. But today we're not talking about the entire sector. We're talking about one bank failure. But we're talking about the one bank failure because this is not going to be the last bank that fails. The article goes on to say that financial regulators have closed Silicon Valley Bank and taken control of its deposits. The Federal Deposit Insurance Corporation announced Friday in what is the largest U.S. bank failure since the global financial crisis more than a decade ago. Now, I've shared this next story in the past, but it's factually true and I must share it. Back when I was a stockbroker, back during the global financial crisis, back when people were terrified of where their money was put and how safe it was, I was asked to find the safest place to park my father's money. He wasn't interested in any type of return. He wanted to ensure that it was safe, it was guaranteed, and it was secure. And so I went out there and found the Prime Treasury Fund. I talked to industry experts. I talked to money managers and asset advisors and financial planners and went all the way up the food chain to satisfy myself and my father that we had found the safest place to park his money And we were told by all the experts, and keep in mind, I was a stockbroker. I'm in the industry. Now, that's not exactly what I did for a living, but I certainly had access to people that did. And so we found the most secure product that existed that also provided a better return, which means if there is a return involved, there's also risk. But we were placated by every leading expert that this particular fund had almost zero risk, nothing to worry about. So, despite what common sense would tell us, we went ahead and made that move. And that failed. It failed. The prime fund broke a buck. And that had never happened before. It was unprecedented. Money market funds never break a buck. It's impossible to do so until every other bank fails. And at the time, we had Bear Stearns, we had Lehman Brothers, which it should be noted, leading industry experts had been touting the day before as still being a safe investment. Everything failed. Systemic risk was real and people were terrified. I was terrified. My dad was terrified. We didn't know if we'd ever have access to those funds again or if those funds would ever be made whole. It was terrifying. And that's exactly what's happening right now, today, in the collapse of Silicon Valley Bank. There are a ton of people in the venture capital community and companies and wealthy individuals who are completely uncertain as to what's going to happen with their money. And when people are afraid that their money in the bank is at risk, I can assure you the last thing they're thinking about is buying or selling a home. The last thing they're thinking about is making an investment. The last thing they're thinking about is anything other than, is that money safe and secure? And am I going to get it back? I'll say it a little bit differently. Those folks are panicked. And panic is no bueno for the housing market here or anywhere else. And panic is no good for the economy here or anywhere else. Panic is no bueno. But the FDIC has stepped in and announced that insured depositors, and the key term here is insured depositor. You want to make sure that all of your money is insured deposit, because if it's not, it's at risk. But the FDIC went on to say that their deposits would be available no later than Monday morning. Well, between Friday and Monday, there's a lot of people with brown stains in their underwear because until that money's back in their bank, it's not in their bank. But then the article goes on to say, which is something that I just mentioned, that the FDIC's standard insurance covers up to $250,000 per depositor per bank for each account ownership category. It's unclear exactly how larger accounts or credit lines for companies will be impacted by the closure. Well, it's not unclear to me. It's no bueno for anybody. And then it goes on to say that the FDIC said it will pay uninsured depositors an advanced dividend within the next week. And that is not exactly comforting if you happen to be one of those uninsured depositors. As of the end of December, SVB had roughly $209 billion in total assets and $175.4 billion in total deposits, according to the press release. The FDIC said it was unclear what portion of those deposits were above the insurance limit. The last U.S. bank failure of this size was Washington Mutual in 2008, which had $307 billion in assets. Well, before I freak everybody out and create too much panic by sharing this article, it needs to be understood that banks are capitalized today much differently than they were in the past. But there are many banks today that are exposed to many other risks that I don't know that they're capitalized for. And I'll give you an example. The auto subprime loan market has been decimated. And the banks that must repossess those cars are not realizing those losses. They are not selling those repossessed cars because they don't want to take and realize those losses, which will fundamentally change their capitalization. And that's just one example off the top of my head. I don't have a clue how badly impacted many institutions are going to be by what's happening in the crypto space. But I do know that Silicon Valley Bank just shut down, which is no bueno and tells me there is systemic risk that still exists within the banking system. And then it goes on to say that many Wall Street analysts have argued that the struggles for SVB are unlikely to spread to the broader banking system. Well, what do you expect them to say? Did you expect them to say, oh no, there's systemic risk and everybody's doomed? No percent chance of them saying that. Just like there was no percent chance that Jim Cramer was going to say that Bear Stearns was at risk for failure the day before it failed. He was saying, bye, bye, bye. And we all saw how that turned out. And while, yes, I'm the first to admit it is a large leap from this bank failure to the housing market getting decimated, and obviously I'm not rooting for that to happen, but I can absolutely tell you if there is systemic risk, and if that systemic risk is realized, if people are afraid to bank, if they don't believe their cash is safe, well, then home prices and the housing market is doomed. Now, I hope you found this content valuable, and if you did, please subscribe to the channel, give it a thumbs up, share it with a friend, and check out my next video because I suspect you will love it a lot. And until next time,